But now the other big issue that the markets will be watching for will be the inflation numbers that will come in post-market hours today. Anubhuti Sahai, the senior economist, global research at Standard Chartered Bank, joins us. Also joining us on the phone line is Amandeep Chopra, the group president and head of fixed income at UTI AMC. Morning to both of you. Anubhuti, first you. We've got a poll number for CPI at 4.99%. What is, according to you, a number that can surprise the street positively? Anubhuti? Okay, I think we're not able to reach out to Anubhuti. But let me put the same question to Amandeep. Amandeep, this is what the poll is giving us, closer a little south of 5%. But the RBI's fan chart had indicated that we should be reaching 4% by August. What would enthuse you as a fixed income watcher?
Well, I think clearly if there is an undershoot on the CPI data, that will enthuse the markets because, that's been one of the risks highlighted in the latest RBI policy. So I guess any number which is close to 4.885, which is also one of the, estimates within the range given for CPI, would be positive for the markets.
Okay.
But I think beyond the CPI, it's more, other global factors which seem to be right now impacting the view in the, fixed income markets. Okay. So this will be a good trigger today, but let's see. Okay.
So assuming we get a good trigger, but that apart, how long do you think yields are going to remain at the 7.8, almost 7.9 levels, 7.85 levels? After 3 rate cuts, we are still close to the 8% mark. When do you see that abating? Only when global yields fall, or at least when global yields fall?
I think partly yes. If you really look at it, most of the reversal has taken place because of 2 factors. One obviously has been the hardening of yields across most of the developed markets, and a little bit of a sell-off, within the emerging market space. The second has also been the commentary. While we have had 3 rate cuts, the commentary and the outlook going forward continues to remain hawkish. And I think that clearly does have an impact on the sentiment as far as the local fixed income markets are concerned. One big event, I think everyone is now focusing very closely on what the FOMC does in terms of their, sort of rate hike cycle. And I think a clarity on that clearly, in my view, will at least put one big issue behind, us. And then the markets can really start, filtering in the new data that they receive. So I think in the immediate term, maybe, I think FOMC is the biggest trigger. If we were to get some sense of clarity that the rate hike cycle begins in September and, what will be their stance going forward, I think to some extent the markets can then maybe, start pricing in that risk, which right now, singularly remains the biggest factor in influencing local markets.
Just one final word, Amandeep. What exactly has been the outflow from the fixed income market in the last, say, 2 to 3 months, and would you expect it to continue?
You mean from the mutual funds?
Yes.
From the mutual funds, actually, there's been very little outflows. We've actually seen net flows. If you really look at, the latest mutual fund AUM data of close to about 12 trillion rupees, it's been driven by, fairly steady inflows into the fixed income. The segments have changed, as against the duration funds like bond and gilt funds, which typically were receiving flows. Those have slowed down, so you're seeing more flows in other category of fixed income funds. But we've not seen any net outflows as of now at an aggregate level.
Except by the FIIs?
Yeah, but FIIs, yes, they have actually seen, a pullout. But again, it's tilted more in the corporate bond, segment rather than on the G6. In G6, we've seen a little bit of a, position trimming, I would assume, because, frankly speaking, if you look at the way the rupee has reacted and the way the yields have spiked, I think for any FII who's looking to have an exposure in India, I think this provides a good opportunity because there have been a lot of people who've been sitting in the fence trying to time their entry into Indian fixed income markets. So today with rupee near 64 and 10-year, the new 10-year benchmark close to 785, I think it's a decent level to enter.
Okay. Well, finally, would you care for the IIP number at all? How would the bond markets look at it or not look at it at all?
I think IIP is a lesser of a data point to influence local markets. It's more the CPI. And I think that will definitely drive, the move on Monday.
All right. Fine, Amandeep, we'll leave it at that. The expectation is of a 1.16% IIP number, but yeah, bond markets will more watch out for inflation. Though, I mean, repeated debilitating IIP will also be a little bond positive and terribly equity negative. So that number has a little bit of import. We'll take a break on that note. We are not able to connect with Stan Chart. We'll try.